Welcome to the viewers. Today in the session we are going to discuss funds flow statement. The basic financial statements of any company is profit and loss account and balance sheet. This profit and loss account and balance sheet is usually prepared by any company or in a business organization to know the financial results and financial position of the company at the every year end. But these financial statements are going to be useful both the internal and external stakeholders of the company or a business organization. Whereas this funds flow statement is specifically prepared for the purpose of internal management by the managers, because managers are managing the company. In this context, they wanted to know the important information which is not going to get through the existed financial statements, that is profit and loss account and balance sheet. Now we will see the slides one by one. The funds flow statement. This topic is going to cover introduction, meaning and concept of funds, meaning and concept of flow of funds, list of current and non-current accounts. In the introduction, when you see it, there are two basic financial statements that we are well versed with these two. That is profit and loss account and balance sheet. Profit and loss account is representing the results of the business. These results of the business is in the form of profit or loss at the every year end. Profit or loss. Whereas balance sheet reveals the financial status of the company at a point of time. These two has to be properly understood by the students. That is, number one is period of time, number two is point of time. Here in case of profit and loss account result, here in case of balance sheet the financial status. So profit and loss account represents the financial results, the results in the form of profit and loss at the period of time, for a period of time. Period of time means at the end of the year. That is the reason why when we are preparing profit and loss account, we used to write profit and loss account for the year ended 31st March 2020. But whereas in the case of balance sheet, we used to write balance sheet as on 31st March 2020. So in this context, what I am telling that the profit and loss account is recording only the expenses and revenues for that current year only, not to the past years. But whereas in the balance sheet, all the assets and liabilities, whenever you purchased, you might be purchased from last 10 years back or 20 years back, all this going to be represents in the balance sheet. After reducing the depreciation, reducing the other provisions, this is going to be appear in the balance sheet. So that is the reason why this is prepared point of time. That is the reason why we used to write in case of balance sheet as on date. That is the basic difference between profit and loss account and balance sheet. Once again, I am stressing to the students that why in the profit and loss account case it is written as a for the year ended, whereas in the case of balance sheet as on that date. These two things you have to clear cut understood. And then goes back to the further the funds flow statement is going to represents the changes in assets and liabilities from one period of time to the another period of time, but it is not possible with the balance sheet. When you see the two balance sheets for the two different periods of time, these two balance sheets assets and liabilities are differ from one value to the another value, but this balance sheet cannot explain why these differences are happening. But in case of funds flow statement, when you prepare the funds flow statement, it is very easy to understand the changes in assets and liabilities of two balance sheets from one period of time to the another period of time. In addition to that, the funds flow statement again explains how these funds were obtained, how these funds were procured, and how it has been mobilized, in what manner these funds are employed or used. That we can also understand through the funds flow statement. So here in this funds flow statement, we used to know the first is changes in assets and liabilities of one period of time to the another period of time. That means when you take the two balance sheets, last year balance sheet and this year balance sheet for the same company, the values are differs. That represents by the balance sheet, but we do not know why the difference is happening. That reasons can be known through preparation of funds flow statement. In addition to this, one more reason how these funds have been procured or mobilized or obtained, in what way we have obtained these funds, and how these funds were employed or used, how we utilized these funds, how we employed these funds. This can be known through the funds flow statement. And before going further, we have to know the meaning of and the concept of funds. The funds has been defined in a number of ways. That is, in a narrow sense, it means cash only. In a broader sense, it means all financial resources. In a popular sense, it means working capital. These are the three different ways the funds have been explained. In a narrow sense, when you are taking it as cash only, that means in a general person, if you ask anybody, do you have funds? That means they feel somebody is asking him, do you have cash? If somebody asks me, do you have funds in packet? I say, in my packet I have 1,000 rupees. That means I am considering funds means cash only. That means that is a narrow sense. In another case, broader sense, it means all financial resources. That is nothing but all the assets which can be converted into finance is considered as a financial resource in case of broader sense. But whereas in a popular sense, it means working capital. This is the concept which we are going to use for explaining the funds flow statement. So working capital is more important concept to explain the funds flow statement. Whole funds flow statement is prepared depending upon the working capital. That is the reason it is very essential to understand working capital concept in depth. First, we see the definition of working capital. Working capital means the excess of current assets over current liabilities. That means the excess of current assets. Current assets are more over the current liabilities. Whatever the leftover current assets, it becomes working capital. You can also see the in formula manner, that is working capital is equals to current assets minus current liabilities. In generally, this definition can be put into in different manner. That is, working capital is nothing but the expenses incurred for the day-to-day operations is called as working capital. In general definition, simple definition, anybody can understand. Working capital means the expenses incurring, spending for the day-to-day operations of the business is called as working capital. In a narrower concept of funds, that is cash concept, fails to reveal the changes in the total financial resources of the business. When you take the only cash concept, this cash concept is going to fail to study all the financial resources of the business. This cash concept is not going to consider remaining financial resources of the business. This considers only cash. Depending upon this concept, if somebody prepares, that is called as cash flow statement. However, the concept of funds as working capital is the most popular one, and it considers the changes in the total financial resources of the business. This concept of working capital is considers the changes in the total financial resources instead of cash. That is the reason why this cash flow statement is more popular than the cash flow statement, because it considers all the financial resources. After knowing the meaning and the concept of funds, we have to know the meaning and the concept of flow of funds. What is meant by flow? First, we have to know the meaning of flow. Flow means movement. Flow means movement. This movement, either it may inflow or outflow. Movement of funds either inflow into the business organization or outflow from the business organization. Movement means change, moving from one place to another place. That is called as a flow. Flow means movement. This flow of funds. Now we will go further. After knowing the meaning of funds and flow, then we try to know the meaning of flow of funds. Means transfer of economic values from one asset to the other asset. Flow of funds means transfer of economic values from one asset to another asset. When you purchase machinery for the cash, your cash is going out and the machinery is coming in. That means transferring of economic values from one asset to the another asset is called as flow of funds. Whatever the transaction which is happening in the business that leads to the transfer of economic values from one asset to the another asset, that is called as flow of funds. It is, when you see it in a general sense, it means change in the amount of funds available. Change in the amount of funds available in the business. Today there might be 1 lakh rupees funds available in the business. Tomorrow there might be more than 1 lakh rupees or less than 1 lakh rupees. That means changes has to be happening in the amount of funds available. That is nothing but flow of funds, and also you can say it as transfer of economic values from one person to the one asset to the another asset. If the transaction taken place, if it leads to the increase of funds, once the transaction is happening in the business, if it leads to the increase of funds, it is called as source of funds. There are a lot of transactions that are happening in the business on a daily basis, but if it leads to increase of funds, that means source. Students, try to remember, increase of funds means source of funds. Increase of funds means source. Source means the flow is coming into the business. Next, decrease of funds means application of funds. That means available funds are utilizing for some purpose. That means funds are going out. Funds are flowing from business to the outside. That is called as a application of funds. This application of funds is nothing but outflow, whereas source of funds is nothing but inflow. That is the difference between source of funds and application of funds. Students, try to remember one important point. Increase of funds is nothing but source of funds. It is also called as inflow. Decrease of funds is nothing but application of funds, that is outflow. According to the working capital concept of funds, the term flow of funds refers to the movement of funds in the working capital. If the transaction results in increase of working capital, because why increase of working capital we are using? Instead of increasing of funds, we are using it as increase of working capital. Instead of using increase of funds, we are using it as increase of working capital. That means in this context, we are considering it, that is funds, as working capital. That is the reason why we are using term increase of working capital is called as source or inflow of funds, and if it results decrease of working capital is called as application or outflow of funds. So increasing of working capital is nothing but a source of funds and also is called as inflow, and if the results decreasing of working capital is called as application or usage or outflow of funds. This is everybody should have clear cut understanding, because when we are preparing the solving the problems, a student must clear knowledge about flow, funds, flow of funds, working capital, movement, inflow, outflow, source, application, and all these terms has to be clear cut knowledge. Otherwise, again, it is a problematic while solving the problems. Next, in the slide, we have to go to the next slide, current assets and non-current assets. These are the basic components for preparing the changes in working capital statement. Rule is the flow of funds occurs when transaction changes on one hand a non-current account and on the other hand a current account, and vice versa. The flow of funds occurs when a transaction changes on one hand a non-current account and on the other hand a current account, and vice versa. It means funds do not move when the transaction affects fixed assets to fixed liability or current asset and current liabilities. So we all know what is meant by transaction. Transaction is nothing but any event which is happened in the business. What is the event? Let's take an example, machinery purchased for cash. In this transaction, the transaction is a machinery purchased for cash 10,000 rupees. This is a transaction event, because why it is called as an event? One asset is coming in, another asset is going out. When the machinery is coming out, cash is going out. Cash is a current asset, machinery is a non-current asset. So when the transaction is involving with the one account is current and another account is non-current account, there is a flow of funds. If the transactions is involving with both the current accounts, both the non-current accounts, that means there is no flow of funds. That should be clear. This rule is very, very important, because when the transaction is involving both the accounts of current accounts or both the accounts of non-current accounts, then there is no flow of funds. If the transaction is involving with one current account and another non-current account, that means there is a flow of funds. Let's an example, machinery purchased for cash. Cash is current account, machinery is non-current asset, so there is a flow of funds in this transaction. Let's take an example, other example. Received from debtors, 10,000 rupees received from debtors. In this case, debtors and cash both are current accounts. So entry is cash account debtor to debtors account. That means both accounts are involving in this transaction is current assets account. Hence, there is no flow of funds in this transaction. So students, we will explain this in the further classes in depth, but try to understand now. Remember, there are current accounts, there are non-current accounts. Current accounts means current assets and current liabilities. Non-current accounts means long-term liabilities and long-term assets or fixed assets. When the transaction is happening, with the current account and with the non-current account, then there is a flow of funds. Otherwise, there is no flow of funds. To understand the flow of funds, it is very essential to classify the various accounts into current and non-current accounts. Current accounts can be classified as current assets and current liabilities. Current assets are those assets which can be converted into cash within an accounting year without losing any value. And current liabilities are those liabilities which are to be paid within an accounting year. So first try to understand the meaning of current assets and current liabilities. The current liability is a liability which is to be repaid or paid within an accounting year is called as a current liability. Current asset means an asset which can be converted into cash within an accounting year without losing any value. That is called as a current asset and current liability. We know the meaning of working capital, know the meaning of the current asset and current liability. And now we will further proceed. What is non-current accounts? Simple, very simple. Non-current asset, non-current account means it is a long-term liabilities and fixed liabilities is called as non-current accounts. You know all very well what are the long-term liabilities, what are the fixed assets, and also we will learn once again in the further sessions. Now we will see the list of current and non-current accounts. What are these current and non-current accounts broadly classified into four categories? That is current liabilities, current assets, non-current or permanent liabilities, long-term liabilities, non-current or permanent assets and also called as fixed assets. Once I will just read out the current liabilities and the current assets for the students purpose, or otherwise you can go through once the list of current liabilities, current assets, non-current liabilities, that is long-term liabilities, non-current or permanent or fixed assets. So when you see the current liabilities part, bills payable, sundry creditors, and also called as accounts payable, accrued or outstanding expenses, dividend payable, bank overdraft, short-term loans, advances and deposits, provision against current assets, provision for taxation, provision for dividend. Students, remember provision against current assets is simple. Let's take an example. Bad debts provision provided RBDD, reserve for bad and doubtful debts on debtors created. That is called as a provision against current assets. And comes into the current assets, cash in hand, cash at bank, and you know because you are studying in the final year, you might be come across all these in your corporate accounting, current assets, current liabilities, and you are preparing from the beginning balance sheet. So you all know only thing is you try to segregate as current and non-current. You all well versed with what are the fixed assets, what are the long-term liabilities, what are the short-term liabilities, what are the current assets. So with this session, in the next class, how to find the flow of funds will be explained in the next session. Thank you for watching this video. Thank you.